Lesson 1: Accounting and Taxation. In this chapter, we'll discuss about basics of accounting and various taxes levied in India. If you are not from the accounting background or are not familiar with the general basic accounting terms, then this chapter will be very helpful to you, as in this chapter we'll discuss from very scratch. That is, we'll discuss only the basic parts of accounting, basic terms used in accounting, and an overview of the various taxes levied in India. First of all, we'll discuss what is accounting. Accounting is the art of recording, classifying, and summarizing transactions of the business in a prescribed format in order to use this information to take managerial decisions and for smooth running of business. Prime motive for doing any business is to earn profit, and to know the profit earned or loss incurred in a period. It is, however, necessary to record all the financial transactions of a period in a prescribed format. Basically, if you have recorded all the financial transactions in a prescribed format and for a particular period, then only you can ascertain the profit and loss incurred in a particular accounting period. There are certain general concepts upon which accounting is based. In this chapter, we'll discuss the three basic concepts of accounting. First is business entity concept. According to this concept, business is a separate entity from its owner. That is, business entity can be a company, firm, or proprietorship. For example, a person, Mr. Kamal Chopra, has started its business with the name Chopra and Enterprises. Now, Kamal Chopra and Chopra and Enterprises are two different entities. Next is dual entity concept. According to this concept, each transaction is recorded in two different accounts. Worldwide, dual entity concept is followed, which implies that whenever a transaction happens, minimum two accounts are affected. More than two accounts can also be affected, but at least two accounts are affected under dual entity concept. For example, if you have purchased machinery in cash, then machinery and cash, both accounts will be affected. Next is accounting period concept. According to this concept, accounts for a business are to be prepared for a specific period, like 12-month period. Like in India, an accounting period from 1st April to 31st March is followed. So it is very necessary that accounts are maintained on yearly basis or for a prescribed period. Next, we'll discuss the golden rules of accounting. In accounting, we have to remember only the plus and the minus of a transaction, that is, in which account amount is to be added and from which account amount is to be subtracted. In layman language, we can say that when you give money to a person, then you add the money into that person's account, and when that person gives money back to you, then you subtract that amount from his account. Same rule applies for accounting. The basic difference is that here, instead of plus and minus, we'll use the term debit and credit. Now you will be thinking that plus and minus is very simple, but how can we ascertain the debit and credit aspect, that is, which account is to be debited and which account is to be credited? Well, for this we have three golden rules of accounting. These golden rules of accounting are categorized on the basis of accounts. First is real account. In case of real accounts, the rule which we follow is debit what comes in and credit what goes out. Next is nominal account. In case of nominal accounts, the rule which we follow is debit all expenses and losses and credit all incomes and gains. That is, whatever income or gains you have to credit them, and expenses or losses are to be debited. Next is personal account. In case of personal account, debit the receiver and credit the giver. So these three are the golden rules of account. Learn these rules by heart. If you know these rules, then you will never have confusion of debiting which account and crediting which account. It will be very easy to judge the debit and credit aspects of an entry based on these three golden rules. Next, we will discuss the basic accounting terms. Here we will discuss very basic accounting terms which are generally used in the accounting. First is debit credit. The term debit and credit refers to the addition to or subtraction from an account. That is, debit and credit refers to addition to or subtraction from an account. Real accounts are cash, goods, stock, furniture. Nominal accounts, salary, interest, loan, profit loss on sale of account. Personal accounts are capital account, bank account, or any person's account like Ramlal and Sons and Shamlal and Sons. Next, asset. Assets are resources owned by a company. It can be anything that enables a business to get a profit. That is, the resources that you own and that gives you some profit. Liability. A liability can be defined as something that a business owes to a third party in the form of an obligation to pay. For example, loan. If you have taken any loan and you have to repay it, then that is your liability. Next is capital. Capital is the money that owners invest to start the business and they can claim it from the business. Income is money received by a person or organization because of the efforts done. That is, if you have done some efforts and you get rewarded for that in terms of monetary terms, then that is your income. It can be return on work done or returns on investment. Expense, any amount you have spent in order to produce or sell the goods and services which produce the revenue. That is, whatever expenses you have made on producing or selling of the goods or services is your expense. Next, debtor and creditor. A debtor is a person or business concern that owes money to the company, and a creditor is a person or business concern to which the company owes money. That is, debtor is the person or business from whom you have to take back the money, and creditor is the person or business entity to which you have to give the money. Now we'll discuss the taxation part. Indian taxation structure has now become very easy and simplified after the introduction of GST. Now in India, almost all types of taxes are subsumed in GST. The basic three types of taxes that are followed in India are GST, TDS and TCS. We'll discuss all these three taxes in detail, starting from goods and services tax, that is GST. GST is an indirect tax which has replaced many indirect taxes in India. Under GST regime, tax is levied at every point of sale. The three main components of GST are CGST, which is charge on sales within the state, SGST, charge on sales within the state again, and IGST, charge on sales outside the state. CGST and SGST are levied when you are making local transaction, that is within your state. For example, if GST at the rate of 14% is charged in local transaction, then 7% CGST will be charged and 7% SGST. And if you are making any sale outside your state, that is in central transaction, IGST will be charged, and if the tax rate is 14%, then total 14% IGST will be charged, and that will go to the central government. In most cases, tax structure under GST will be as follows. If you have made sale within the state, then CGST plus SGST, and if you have made sale outside the state, then IGST will be charged. Next is TDS, tax deducted at source, or TDS is means of collecting income tax in India. Different TDS categories are interest from bank, rent on building, machinery, commission or brokerage, fees from professional services. So this is TDS. Next is TCS, tax collected at source, or TCS is a means of collecting income tax in India collected by the seller of the specified goods from the buyer at the time of sale of such goods. For example, you have sold scrap worth rupees 10,000, then you can take 10,100 from the buyer, that is 10,000 for the scrap and 100 as TCS at the rate of 1% on rupees 10,000. TCS is generally implied on sale of scrap for parking lots. In this chapter, we have discussed about the three golden rules of accounting, basic accounting terms, taxation structure of India. Thanks for watching. For more videos, subscribe to our YouTube channel.